Stage 4 in trading, the break-even trap of conscious competence. You want the hook. Here it is. The most dangerous spot in this business is not when you are getting smoked. It is when you convince yourself that not losing equals progress. That soft plateau looks like safety, but it is a padded cell with nice lighting. Your own description gives it away. You take every system signal. You let winners run to their supposed final destination. You slice the losers quickly. And week after week, you hover near, even some days a small green, some days a small red. On the statement, it looks tidy. Inside your head, it feels calm. Under the hood, it is entropy. The claim is simple. The system makes more than it loses over time. The reality you quietly admit is simpler. Some weeks a few hundred up, some weeks a few hundred down. And overall, you are not losing. That is not momentum. That is a treadmill with a nice view. You are calling purgatory a penthouse because the elevator is not falling. You say losses are as easy as wins now. I hear abdication wearing a suit. Conscious competence turns into conscious compliance. Click the alert fires, you hit the order and call it professional. Snap the stop-loss cuts like a bee, knife, and you shrug. No sweat, planned risk. Thud, the winner gives back a chunk while you let it work. And you label the patience edge. That soundtrack feels grown up because the beats are predictable. Predictable is not mastery. Predictable is anesthesia. Fear is muted. Sure, but so is sensitivity. The tape breathes and you do not. You hand your pulse to a rule set and brag that you no longer flinch, while the market quietly measures how often you show up in the same clothes with the same tells. When the routine starts trading you instead of you trading the routine, that is not discipline. That is a leash. Then comes the rationalization that exposes the rot. You tell yourself a day that makes 50 and loses 30 is not a loss because the system brings it back. That is not resilience. That is superstition with a spreadsheet. Mean reversion does not owe you a rebate, and variance does not sign a contract to pay your rent. If the equity line coughs forward a few bucks and then hands it back with a dull clunk, you are not flat. You are paying hidden taxes, opportunity cost, decision fatigue, and the slow erosion of conviction. Paper cut after paper cut. The account does not scream, so you call it fine. Bleeding out red ink does not always gush. Sometimes it seeps in a steady, quiet drizzle you learn to ignore because the calendar keeps flipping and the deposits keep surviving. That is how mediocrity hardens, by never being dramatic enough to trigger an intervention. Another hazard masquerading as maturity is the vow to take every signal. Sounds systematic, smells reliable, but what it signals is indiscriminate. Markets rotate through personalities' expansion, compression, trend, chop, and the exact same rule set that fed you last quarter starves you this month. Fire at every alert with the same aggression and you are not consistent. You are farmable. Liquidity hunts that rhythm like a metronome. Tick-tick stop gets tagged. Tick-tick runner stalls. You call it variance, as if roulette owed you symmetry. It does not. The day trading rug pull loves a trader who cannot skip a beat. Because skipping a beat requires judgment, and judgment requires risk of being wrong without a script to blame. The script becomes a shield, and shields are heavy. They slow you just enough to be late to every real move and perfectly on time for every trap. You lean on the mantra, cut losers, fast and let winners run, as if that sentence alone is an edge. It is not a shield. It is a scalpel. In shaky hands, it carves you up clean. Cut too fast inside noisy structure, and you stack neat rows of tiny realized hits that one decent runner never fully repays. Let it run in a dead tape, and you donate unrealized hope back to the auction. The gap between prudence and passivity is a thin wire, and you are tap dancing on it while telling yourself the choreography is skill. The line, "let it reach the final destination," slides from patience to neglect the moment the destination is assumed rather than observed. That is the quiet part no one says out loud. A stop-loss that slices on cue and a target that exists only in imagination will produce beautiful journal screenshots and very average money. Then there is the scoreboard you cling to. Some weeks a few hundred up, some weeks a few hundred down, and overall, you are not losing. More accounts rot on that plateau than on any theatrical blow-up. The flat line does not train you. It numbs you. Churn becomes normal. Feedback blurs. And randomness gets rebranded as consistency. The market indulges that belief with crumbs, then yanks the tray. The moment fatigue loosens a screw. The air pocket that follows does not come from nowhere. It is the invoice for confusing motion with progress and process with edge. You kept telling yourself the money always comes back. Sometimes it does. Sometimes the next regime arrives, and it does not. If that thought lands like a gut punch, good, because it leads to the question stage 4 keeps dodging. If break-even is your comfort zone, what exactly is powering your supposed edge? Once the personality of the market changes and the machine you trust starts to stall, you want cause and effect. When the market shifts personality, your break-even routine turns from armor into wet cardboard. The promise inside your line, take every system signal, cut the losers. Let the winners reach the final destination, relies on a distribution that behaves. The tape does not behave. It mutates. Expansion becomes compression with a muffled thud. Momentum becomes grind with a sandpaper hiss. Your rule set keeps firing, click, 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 while probability quietly relocates. The edge you swear exists is actually concentration risk disguised as discipline. A handful of outsized runs are supposed to pay for endless tidy paper cuts. Fine, until the runs stop running. Or they run thinner. Or they run later than your tolerance. Then the math you brag about is not expectancy. It is exposure to a tail that no longer visits. Look closer at that mantra. Let winners run to the final destination. Destination, according to whom? The market rescans itself each session. Your preloaded target is an old snapshot with a fresh caption. You call the give back a cost of doing business. I call it anesthesia wearing a halo. The moment a trade slips from structure into hope, the difference between patience and negligence becomes a whisper. You do not hear it because the routine is humming. Worthy alert. Clack the entry. Slice the stop. The ritual feels crisp, yet the thinking is dulled. When the best you can say about a day is that a green number offset a red number and net you stayed flat. What you really admitted is that the auction extracted time, while lending you certainty. Certainty feels like profit because it is smooth. Profit is not smooth. It is lumpy, ugly, and seasonally scarce. You also claim losses are as easy as wins now. Congratulations. You numbed the nerves. Numb is not grown up. Numb is blindfolded. Pain is feedback, not an enemy. When you cannot feel the sting, you also cannot feel the subtle shift when the order flow starts favoring faster exits or partials, or when the same setup requires smaller initial risk to survive the noise. You do not sense it because the plan says what to do, and you obey. Obedience gets marketed as professionalism. In trading, the obedience without discrimination is how you get farmed. The tape watches repetition like a hawk. It tracks your stop placement cadence, your add-on rhythm, your tolerance for pullback. Tick-tick, your footprint becomes probabilistic food. You still call it variance. That label works until it does not. Then there is your accounting trick. A day that makes 50 and loses 30 does not count as losing because the system will give it back. Sounds cool on a podcast. Sounds flimsy in a ledger. That line hides spread, slippage, and the silent drag of clicks that did not need to exist. Click. Partial fill. Slip. There goes the tidy math. You are not just hovering at break even. You are buying the right to say you are consistent. The price is opportunity you never measure, attention you burn, and conviction you dilute. The statement prints flat, so you declare stability. Stability here is not the absence of downside. It is the absence of learning. The grind is not teaching you nuance. It is teaching you tolerance. You can endure 1,000 tiny cuts. Great. Can you recognize the one situation that deserved a second unit of risk because the auction structure screamed it? That recognition muscle atrophies inside a routine that praises sameness. You mention a timeline, 6 months to 2 years, then a neat arrow toward the next stage. That is the sedative baked into stage 4. Endurance looks like evolution. Surviving that long does not prove readiness. It proves you have the bankroll, the temperament, and the stubbornness to keep feeding the machine. The machine loves a steady feeder. The account does not implode, so you call it maturity. But count the seasons you silently skipped, a regime where chop took your lunch. A regime where trend would have paid you if you had scaled differently. A regime where volatility begged for smaller clips and tighter management. The routine never flexed. And because it never flexed, you never had to ask whether your so-called edge was adaptive or just static rules that accidentally fit last quarter's tape. Evolution in markets is not guaranteed by time served. It is gate-kept by sensitivity. And sensitivity is the first casualty of numb competence. You also frame the certainty of taking every signal as the virtue that separates you from emotional traders. Cute. The virtue you brag about is the same rigidity that prevents you from noticing when the quality of those signals decays. Signal quality is not binary. It is a slider. The context that upgrades or downgrades each alert is what you outsource to the plan. Outsourcing context feels safe until the context changes and the plan keeps marching like a drumline straight into a wall. Thunk. The week closes, near flat again, and you pat yourself on the back for not blowing up. Meanwhile, the craft you think you are practicing has been reduced to attendance. You showed up. You executed. You accepted outcomes. And you learned nothing that would change the next sequence beyond. Keep showing up. And this is where your own script corners you. If the period you describe, 6 months to 2 years of tidy oscillation, can either be a bridge to stage 5 or a cul-de-sac with polite signage, how do you tell the difference without inventing a happy story after the fact? You want systemic. Stage 4 is a factory for quiet, delusion, mass-producing traders who can execute a checklist but cannot detect when the checklist stops paying. The very features you highlight, taking every signal, cutting losers fast, letting winners reach that final destination, and ending weeks near flat, form a closed loop that rewards obedience and penalizes sensitivity. Click, enter, slice, exit, drift, give back, repeat. The loop teaches you to love clean mechanics and ignore context drift. When the market mutates, the loop does not. That is the first structural mistake almost no one suspects. You are measuring your skill by your ability to repeat a behavior, not by your ability to discriminate when that behavior is mispriced by the current auction. The second mistake hides inside the comforting phrase, not losing money. Break-even is not neutral in practice. It is negative. Once you account for the soft costs you pretend are air, I do not mean fees, save that sermon. I mean cognitive load, attention scarcity, and conviction erosion. Every small red that gets neatly clipped chips away at your willingness to press the rare stretch when the tape actually breathes your way. By the time a runner appears, your tolerance for heat is lower, your patience for structure is thinner, and your trigger finger is trained to take the first safe partial because the loop has reinforced one thing: survive. Survival is necessary. It is not sufficient. When survival is your core identity, growth becomes an accident, not an outcome. Third mistake, the myth of even distribution. Your Stage 4 script assumes a handful of sizable winners will offset a swarm of tidy losses. So the advice is to let them reach the final destination. Sounds rational until the distribution thins. Runs become shorter. Extensions stall earlier. Pullbacks get nastier, by a hair. You still hold because the plan says hold. The equity curve turns into a soft saw blade up a bit, down a bit, while you tell yourself variance is working. Variance is not your friend. It is a landlord. It raises rent without notice. When the rent goes up, your policy of taking every signal pays the landlord first. That is why you call green-red days that net near zero a win. It lets you ignore how much rent you paid to keep the same apartment. Fourth mistake, you confuse numbness with maturity. You say wins and losses now feel equally easy. I hear desensitization. The tape whispers, and you cannot hear it over the hum of your ritual. Whir the alert. Clack the fill. Tap the stop. Thunk the give back. The soundtrack is smooth, so you think you are smooth. Meanwhile, micro shifts, pace, spread, depth. The way candles stack near a level no longer change your behavior, because noticing would require you to break the vow to take every signal. You defend the vow as discipline, but discipline without discretion is a costume the market eventually tears off with one bored shrug. Fifth mistake, the fantasy of destination. Let winners reach the final destination suggests a path, exists independent of current conditions. Destinations are not discovered. They are negotiated bar by bar. When you outsource that negotiation to a static target, every small regression to the mean feels like standard noise, even when the structure has already flipped from expansion to compression. You hold because the story says hold. The story is comfortable. The tape is not obligated to respect your story. Sixth mistake, the timeline lullaby, 6 months to 2 years. Then stage 5. That span sounds like growth, but it can be pure drift. Calendar time lets you tell a heroic narrative. I stuck it out. Therefore, I evolved. Or maybe you endured a long hallway with identical doors and never tried a different handle because the rulebook said consistency beats tinkering. Consistency does beat desperation. It does not beat adaptation. If your plan today would have made the same decisions 12 months ago in a different market personality, what changed? Besides your tolerance for watching small numbers bounce around. Seventh mistake, you celebrate attendance as mastery. That is about you showed up, you executed, you accepted outcomes. Good. Now ask the question your script avoids. Where did selectivity go? Taking. Every system signal is efficient for a backtest and expensive in real time when signal quality slides along a spectrum you refuse to acknowledge. You gave up the right to pass, and with it, you surrendered the only lever that separates a rule follower from a trader discretion grounded in current context rather than historical comfort. That lever rusts quietly while you congratulate yourself for being consistent. And under all of it sits the most corrosive premise of Stage 4, calling flat performance proof that the machine works, instead of proof that you work for the machine. If the ritual keeps you safe while the tape evolves without you, are you practicing the craft or rehearsing a routine that looks like craft until the lights shift? You want contrast. Here is the split screen. On the left, your Stage 4 narration in soft focus. You take every system signal. You cut losers quickly. You let winners reach the final destination. And the account drifts near break-even, with weeks a few hundred up and a few hundred down. On the right, the live feed with no filter. The market shifts personality mid-week with a dull clunk. Spreads breathe wider at the worst moments. Extensions stall a hair sooner, and your routine keeps marching. Click. Enter. Slice. Exit. Thunk. Give back. The naive version says stability. The harsh version says churn. One feels composed. One is quietly corrosive. You call the first maturity. I call the second the bill underneath your calm. Naive thinking says taking every signal is proof you are not cherry-picking, that you are immune to emotion, that you respect the plan. Harsh reality says taking every signal removes your only adaptive lever when context decays. A plan without a filter is not sturdy. It is exposed. The tape does not pay you for attendance. It pays you for showing up with pressure that fits the current auction. You think obedience equals edge. Edge needs timing, size, and selectivity that shift with the weather. When you refuse to modulate, the market does it for you with a snap. Your risk gets larger in practice because your hit rate sank a notch while your behavior stayed the same. Naive thinking says cutting losers fast makes the math work. Harsh reality says the cadence and placement of those stops matters more than the slogan. If you cut at the same rhythm, regardless of liquidity, your journal shows tidy discipline while your P&L subsidizes slippage and noise. Snip. Snip. Snip clean rows of small reds that your favorite runner is supposed to repay. Except the runner shows up thinner in this regime. Your expectancy now depends on a rare event that arrives less often and pays less when it does. The mantra still sounds good. The distribution quietly changed shape, and you did not. Naive thinking says, let winners run to the final destination. Harsh reality asks, destination according to what structure now? Not last month. The moment your target drifts from observed auction into remembered narrative, you are not letting it run. You are letting it wander. You will label every regression to the mean as normal noise until the tape closes the gate behind you with a low metallic thud. Patience is a virtue when structure breathes. It is negligence when breath is gone. You kept the virtue and lost the context. That is how good ideas bleed out in silence. Naive thinking says some days green, some days red. Net near flat equals safety. Harsh reality says flat is negative when you count the costs you do not log, attention drained across too many clicks, conviction diluted by endless micro hits, and opportunity missed because your trigger finger is trained to take the first. Safe. Partial. You bought the right to call yourself consistent at the price of being present when it actually matters. That is the hidden fee inside your calm. You protect the routine. And the routine protects nothing when the tape stops rewarding it. Naive thinking says losses feel as easy as wins now, so emotions are handled. Harsh reality says numb is not mastery. Numb is muffled signal detection. The tape whispers through pace, through how candles stack near a key level, through the hesitation inside a breakout that used to breathe but now coughs. You will not hear it, because hearing it would force a break from the vow to take every signal. The vow is supposed to save you from fear. In practice, it spares you from responsibility. It gives you a shield to hold when the day ends near zero. So you can say, see, I followed the plan. The plan claps politely while your sensitivity atrophies. Naive thinking leans on the timeline, 6 months to 2 years, and then stage 5. Harsh reality says time served is not time learned. A long plateau can be discipline or drift. The scoreboard looks the same. You call the plateau a bridge. The market calls it a hallway with identical doors. Without context awareness, you keep grabbing the same handle and praising your persistence while nothing opens. The calendar flips. The journal grows. And the only thing that improves is your tolerance for boredom, dressed up as professionalism. Naive thinking crowns consistency as the pinnacle. Show up. Execute. Accept outcomes. Harsh reality points to the missing word in your script selectivity. You outsourced context to a rule set that cannot see the current hour. You erased your right to pass on a low-quality signal. You replaced craft with compliance and expected progress to show up by seniority. If all that obedience has you, hovering near even while you wait for the market to carry you to the next stage, are you truly standing on a launch pad? Or are you sunk into wet cement that hardens a little more each week? You want an escape hatch that does not torch the foundation. Here is the only one I respect. Treat your stage 4 routine like a draft, not doctrine. The plan is a living contract with clauses that activate when reality shifts. That vow to take every system signal fine as a baseline needs a pass clause. Not a vibe, a context meter. Pace, he spread. Depth, how candles stack into a level. And the character of, pullbacks are your 5 dials. When 3 dials slide from clean to messy. Passes, stop being cowardice and start being cost control. The point is not fewer trades. The point is fewer low-quality stabs that feed the saw blade. Click temptation. Pause context. That half second is the difference between attendance and agency. The plan still fires. You keep the right to say, not today, when the auction floats you, a decoy. Your beloved cut losers fast also needs a translation from slogan to location. Fast is not a timing metric. Fast is a proximity metric. The stop lives where the idea is wrong, not where the mantra feels courageous. When the market is breathing in short, crankier pulses, the same rhythmic stop that looked crisp in a trending week becomes a turnstile. Snip, slip. Snip, red confetti. The alternative is ugly but real, except that some entries deserve smaller initial size with a wider invalidation tied to structure, while others deserve the opposite. That is not flailing. That is pricing the environment instead of pricing your comfort. If it sounds like hair splitting, it is. The good money lives in hair splits, not hashtags. Let winners run to the final destination. Also needs a custody transfer from fantasy to auction. Destinations are not promised. They are negotiated one microstructure at a time. The truth no one loves saying on camera is that the tape often pays in stair steps, not straight lines. The alternative is a ladder mindset, partials on objective rotations, not on calendar time. Trail logic that reacts to fresh imbalances, not to what the chart did last month. A willingness to call a run done when the auction starts wheezing instead of praying for encore. You still run the idea. You just stop worshiping a target that was drawn in a different weather system. Thunk, the gate closing behind the late holder, does not have to be your soundtrack. And that break-even badge you wear like a halo. Rip it off and replace it with a tax statement. Flat performance is negative. Once you log the soft costs, you keep pretending are invisible. Attention burned across a dozen needless clicks. Conviction shaved by chains of tidy paper cuts. An opportunity left on the table because the trigger finger got trained to bail as soon as the screen shows a safe green. The alternative is to audit the routine with the same cold eye you bring to an earnings scalp. How many trades this week were truly necessary given the context? How many exits were ritual rather than response? How many entries were taken because the alert fired rather than because the auction actually invited risk? The numbers will not flatter you. Good. Flattery is why you are stuck. You also hang faith on calendar time, 6 months to 2 years, like it guarantees a doorway to stage 5. Time served inside a loop proves durability, not direction. A sharper lens is recency of recognition. How fast do you notice regime shift? How quickly does your size throttle when spread starts hissing? How naturally does the right to pass show up without drama? That is sensitivity, training, not heroics. The equity line may not sing during that phase. The journal will. Fewer trades, cleaner sequences. Less give back. When extension breath fades, that is the smell of adaptation, not luck. Here is the real pivot that keeps your backbone intact. Replace identity slogans with testable questions. Instead of, I take every signal, try, when should this signal be skipped given today's pace and depth? instead of "I cut losers fast." Ask, where is the exact price that proves the idea wrong, and how does today's noise distribution change that? Instead of "I let winners run," ask which objective tells me continuation is statistically likely right now, not in theory. Q&A, not credo. You are not betraying the plan. You are interrogating it in real time. That interrogation is the only shot at keeping the machine while refusing to be owned by it. If that feels like breaking the rules, good. The rules were written for yesterday's tape. Keep the skeleton. Give it joints. Your stage 4 loop got you steady. Steady does not cash out when the auction mutates. Flexible does. So, if the exit door is open and the cement around your boots is still wet, are you stepping out with a plan that can actually bend? Or are you going to keep polishing the restraints and call the shine progress? You want synthesis without fluff. Here is the clean cut. Stage 4 sells you a story of maturity. You can take losses as easily as wins. You can follow the plan like a metronome. You can finish the week a few hundred up or a few hundred down and call it stability. Under the hood, it is a loop with pretty manners. Click, enter, slice, exit, thunk, give back, repeat. The loop flatters your discipline and taxes your sensitivity. You mistook anesthesia for edge. The more you praise the routine, the more the routine owns your attention, your size, your exits, your patience, and finally, your identity. That is why you defend break-even like it is a badge. It is not a badge. It is a ceiling with soft carpet, so you do not notice your head hitting it. What does your own script actually reveal? First, that taking every system signal without a pass clause turns context from a living variable into a superstition. Second, that cutting losers fast means nothing if fast is measured by rhythm instead of location, because noise will scalp your rhythm with a smug little hiss. Third, that letting winners reach the final destination becomes fantasy the moment destination is remembered rather than observed. And fantasy quietly bleeds when the auction coughs instead of breathes. Fourth, that calling days where green offsets red, a win, is how you ignore the soft tax, attention drained, conviction dulled, opportunity numbed. Fifth, that a timeline of 6 months to 2 years does not prove evolution. It proves stamina inside a hallway with identical doors. You did not evolve. You endured. So, what is left when you strip the slogans? Sensitivity. Not. The rainbows and feelings, kind market sensitivity. The willingness to treat pace, spread, depth, and structure as today's facts rather than yesterday's comfort. Sensitivity is the muscle your loop atrophied. You trained for obedience. You need to train for perception. The operator who notices the tape shift a beat sooner decides differently without announcing a reinvention arc. A pass on a low-quality alert is not cowardice. It is pricing the environment. A stop that lives at the exact point the idea is falsified is not bravado. It is the only definition of fast that matters. A partial taken because imbalance stuttered is not fear. It is custody of gains in a market that negotiates, not gifts. The question you have dodged floats right in your copy. If this plateau can last 6 months or 2 years and may or may not lead to the next stage, what breaks the tie? Not more time. Not more trades. Not louder slogans. Only the operator loop replacing the obedience loop. Sense the personality first. Price the risk second. Decide if the signal deserves a pass third. Size to the noise, fourth. Manage the winner as a negotiation, fifth. An audit without vanity, sixth. No mysticism. No hero arcs. Just posture over posture, a plan that bends on purpose rather than snaps by surprise. And do not romanticize the quiet grind. The market is indifferent to your disciplined cosplay. It feeds on sameness. It catalogs your cadence. It taxes your rigid patience. And it rewards the trader who can be boring in execution and ruthless in adaptation at the same time. That is the real break from Stage 4's trance. Reclaim the right to discriminate without inventing a new religion every quarter. Keep the skeleton. Give it joints. If your ego needs a narrative, here is the only one that will not betray you. I am paid to notice before I act, and I am paid again to change my mind faster than my comfort would prefer. So if you are still nodding along to break even like it is a virtue, listen to the quiet sounds underneath your routine, the hiss of wider spread, the cough of a tired extension, the dull clunk when a target that used to hit now stalls one rotation early. Those are not annoyances. Those are invoices. You can keep paying in small, polite installments forever, or you can renegotiate the contract while you still recognize your reflection. Thunk. That was the gate closing for the late holder. It does not have your name on it unless you let the loop sign for you. If this hit like a gut punch, you know what to do with it, share it with your crew, and tell them why it stung. And if you want more of these raw breakdowns without sugar and without sermons, subscribe to Flow State Trading so you do not miss the next cut.